All right, let's dive straight into this explainer. Today, we're unpacking one of the absolute greatest wealth building engines humans have ever created. Most of the time when we interact with the global economy, we're strictly playing the role of the consumer, right? We hand over our hard earned cash for clothes, software, daily services, you name it. But there is a massive, fundamental shift that happens when you flip the script. When you transition from just being a consumer to actually owning the means of production, you're no longer just buying a product, you are acquiring fractional ownership in real, breathing, growing businesses. It's like this invisible web of transactions happening all around us every single second, and truly understanding how to tap into it, well, that is an absolute game changer for your financial future.
Think about it for a second. We all get so bogged down in the daily noise, right? The red and green charts, the heady financial jargon on the news. But if you strip all of that away, the market is offering you something profound. What if you could actually own a tiny piece of the brands you're already using every single day? Whether it's the massive company behind your favorite ice cream, a booming toy factory, or even the tech titan that built the very phone you might be holding right now, it completely flips your perspective. Instead of just spending your money and saying goodbye to it, you're strategically planting it. You're literally owning a piece of the human ingenuity that drives these massive global brands.
So, how does this actually work from the ground up? Let's strip it back to a super simple scenario to see how capital formation works. Imagine a guy, let's call him Rohan, who starts a solo lemonade stand. And it turns out his lemonade is an absolute smash hit. He's selling out daily, the lines are around the block, and he realizes, okay, I need to open more stands. But expanding, buying more supplies, hiring people, that takes serious cash. Cash he doesn't have lying around. So what does he do? He goes to the public to raise funds. He basically says, hey, give me the money I need to expand today, and in exchange, I'll give you a small percentage of my entire company. This right here, this is the exact fundamental blueprint of taking a company public.
And that deal he's making, that is where a share comes into play. When you hand Rohan your money to help him grow, he gives you equity. A share is quite literally one tiny piece of ownership in that company. And it's not just some abstract, theoretical concept. It is a legal claim on the assets and the future earnings of that business. By holding that share, you are essentially teaming up with Rohan. You're leveraging his hard work, his recipe, his whole business operation to grow your own money. It's a brilliantly simple system that lets regular people get in on the ground floor and participate in the success of a growing business. Now, take Rowan's little lemonade stand and multiply it by thousands and thousands of huge companies all over the world doing the exact same thing. Suddenly, you have millions of people who want to buy shares and millions who want to sell them. They need a place to meet up and make those trades instantly. Enter the stock market. It's exactly what it sounds like, a giant, hyper-fast online marketplace. If we look at massive trading hubs like India's National Stock Exchange or the Bombay Stock Exchange, they are basically huge digital networks matching up buyers and sellers in milliseconds. It ensures that whenever you want to buy into a company or cash out your piece of the pie, you can do it seamlessly every single trading day. So you might be wondering, why do share prices bounce around so much? Well, it all boils down to the most basic rule of economics, supply and demand. Think back to our lemonade stand. If Rohan's lemonade is the best in town, everyone is going to want a piece of his business. You have way more buyers than sellers, and naturally, people are willing to pay more to get in, so the price of the share goes up. But on the flip side, what if he changes the recipe and it tastes awful? Suddenly, profits drop, investors get nervous, and they all rush for the exit. When you have way more sellers than buyers, the price plummets. A share's price is basically just a real-time reflection of how the world feels about that company's future. Okay, so what does this all mean for your actual wallet? Let's talk about capital appreciation, basically making a profit. Let's say you spotted Rohan's potential super early and you bought a single share of his company for 100 rupees. Fast forward a few months, the business is booming, he's opened 5 new stands, and now everyone wants in. Because of that massive demand, the value of your share shoots up to $150. If you decide to sell it right then and there to another investor, boom, you've just walked away with a $50 profit. You didn't squeeze a single lemon, you didn't manage any employees, but your money grew, simply because you provided the capital that fueled his success. But wait, it gets even better. Selling your shares for a higher price is awesome, for sure, but that's only half the story. The other way you can make money is through something called a dividend. Now, what happens when a mature, super successful company starts making more cash than it even knows what to do with? Often, instead of just hoarding it, the leadership decides to reward the people who backed them. They take a chunk of those massive profits and pay it out directly to their shareholders. It's essentially a small reward, or a bonus, just for holding on to your piece of the company. It's pure passive income, deposited right into your account.
Now, I know what some of you might be thinking. Why go through all this trouble? Why not just keep my savings in a piggy bank or a safe under the bed? Well, here is the harsh reality. Money sitting in a piggy bank is actually losing value over time because of inflation. 100 rupees today just won't buy the same amount of stuff a year from now. It's a silent wealth killer. But when you put that same 100 rupees into the stock market, you're attaching your money to living, breathing companies that are actively growing, adapting, and increasing their prices. By investing, you give your money the chance to actually outpace inflation and grow exponentially over time.
And ultimately, that's the whole point of this, isn't it? Nobody just invests so they can stare at a compounding percentage on their computer screen. We do it for real-world impact. We're talking about taking delayed gratification and turning it into tangible freedom. People patiently park their capital in the market to fund massive life goals, whether that's saving up the down payment for your dream house, covering the crazy costs of a good education, getting the seed money to start your own business, or just buying back your own time so you can retire comfortably and on your own terms. Investing is simply the bridge that gets you from where you are today to the financial freedom you want tomorrow. Of course, we've got to be real here. Investing is not a get-rich-quick scheme. There's always risk involved, and the market absolutely will have its ups and downs. That is exactly why smart investors don't just throw money blindly at the wall. They follow a very specific set of rules. First, they learn before they invest. They do their homework. They focus strictly on buying into fundamentally good, solid companies. They practice immense patience, understanding that true wealth is built over years, not days. And maybe most importantly, they completely ignore the rumors, the hype, and the panic. They stay cool, calm, and focused on the long game. Which brings us to the absolute bedrock of all of this. The stock market is undeniably a magical place where your money can grow alongside the greatest businesses in the world, but your success hinges entirely on this one crucial truth. Invest in knowledge first, and the money will follow. You have to understand the mechanics, do the research, and make rational decisions. The infrastructure to build incredible wealth is literally sitting right at our fingertips. So I want to leave you with this thought to mull over. Are you going to spend the rest of your life simply handing your hard-earned money over to these massive companies as a consumer, or are you finally ready to use this knowledge, step up, and become an owner?